Okay, good morning, everyone. We are going to get started. There are people still joining, and they'll continue to log in, but we are going to get going in the interest of time. Good morning, welcome. Thanks for being here with us today. Today's webinar is Managing an Aging Membership Base, and this is part one of a long-term issues for credit union series that will continue in February and into the spring. Mike will discuss further, give you some further details about those presentations following his presentation today. On that same note, at the conclusion of Mike's presentation today, we encourage you all to be part of an open discussion by sharing your insights and feedback, asking questions. You can do that by using the chat or the Q&A box found in the bottom right-hand corner of your screen. So please do participate. Please, share your thoughts on this important topic. And with that, I'm going to hand it right over to Mike so he can get started.
Thank you, Erica. Good morning, everyone. Thank you for joining us. I'm Mike Hansen. I'm the president and CEO of MSIC, as most of you know. And today we're going to start the process of talking about some long-term issues. Managing an aging membership base is the first one because it's one of the biggest concerns for our 73 member MSIC member credit unions. So we'll start with this one. And as Erica said, I like this to be a discussion. And so please submit your questions, your comments to Erica. And at the end, there'll be plenty of time for us to engage as best as we can within this online format. So let's begin. When we look at the current conditions of the MSIC cooperative, we see a very healthy set of financial institutions. Assets are way up, 4.69% since last December. Capital is now over 11%, way above the regulatory minimums. Delinquencies are very low, and our member credit unions are, for the most part, well run with experienced leadership. All but 4 of the 73 institutions are well capitalized under the NCUA's prompt corrective action regulations. So things are good for our member institutions and thereby for MSIC as we sit here as of September 30th. Membership numbers are up as well on average. However, if you take a longer term view, instead of quarter to quarter results, you take a longer view and there are some warning signs that are clearly flashing. And we, in order to ensure the long-term survival of our movement, we need to pay attention to those. As Erica said, this is the first of a series of webinars we're going to do in 2023, which are going to discuss these longer term trends that are affecting credit unions generally and our cooperative. Today, we're looking at demographic changes in the membership base of nearly every one of our member credit unions. So just to remind you a little bit about MSIC, who are we? And when I say we, I mean all of us. We are the first in the nation to provide deposit insurance to credit union members. We're a true cooperative. We were formed 9 years before there was NCUA deposit insurance. And we celebrate our 61st anniversary this January at our upcoming annual meeting. We have 74 institutions, which includes MSIC, and we have $31.5 billion in total assets. Our capital is over 11%. That's $3.4 billion in capital within our cooperative. MSIC insures approximately $2.4 billion in excess shares and deposits as of today. And we all have approximately 1.7 million consumer and organizational members. And MSIC as a cooperative is the 4th largest credit union cooperative in the world. So it's an extremely successful track record that all of us are responsible for. So our research, we do a lot of research at MSIC because we track trends in order for us to maintain a low deposit insurance risk. We have an active risk management program that helps our member institutions. Many of you have worked with us on these types of services, and we also monitor the condition of the credit union movement and our members. But the research shows that across the nation, the membership in credit unions is aging rapidly on average, and our member credit unions are no different than what we're seeing nationwide. Now, an aging membership results in a few negative trends. Some of them are obvious, some of them might not be so obvious. Credit unions with this problem will find themselves with many more savers and fewer members seeking loans. This is standard life cycle analysis. But it also leads to more pressure on overall earnings, as institutions will be less likely to maintain yield spreads on investments as compared to loans. Now, that's not happening right now because during the pandemic, a lot of our members bulked up on their investment portfolios because we had a surge of deposits that came in, and there was no loan demand to meet that surge over the last 2 or 3 years. And so investment portfolios grew substantially. And with the immediate increase in interest rates, earnings are up because they can reprice those investments at a much higher yield. But that won't last for long because with the interest rates increasing, the rising interest rate environment will result in a much higher cost of funds as institutions have to compete to retain those deposits. And we're already seeing that. Some of our competitors, Eastern Bank, for example, is today offering a special 1-year CD at 4.59%. That was unthinkable just a year ago. And so we're going to see increasing pressure, an increase in your cost of funds as you burn through your excess liquidity that you may have received during the last 2 years. And now you've got to compete and maintain market share within your membership. Now, a lack of a vibrant new loan pipeline will lead almost certainly to a loan portfolio being underwater in a rapidly rising interest rate, especially after this long period that we've had of generational low interest rates that goes back all the way to 2007 and 8. We have been in a declining interest rate environment for 20 years. And in the last few years, those interest rates have been lower than anything any of us have seen in our lifetimes. Now, if those loans are still on your books, those low interest loans will have a longer average duration. Now, we, as many of you know, have been recommending that if you're making mortgage loans over the last 3 to 5 years, we have been encouraging everyone to sell those in the secondary market and take the fees, but get that interest rate risk off of your balance sheet. But for loans that you still have on your balance sheet, consumers are going to keep them, and they're not going to be refinancing anytime soon now that interest rates have taken a dramatic spike upwards. So in this new interest rate environment, it's going to take time for the mortgage loan market to adjust. It will adjust. Consumers are still going to need new homes, and people are still going to need mortgages and home equity lines of credit. But it takes time for consumers to adjust to the new higher interest rates. But in the meantime, dried up loan pipelines are the result. And virtually all of our members are seeing a sharp decline in their loan pipelines right now. So if you're experiencing this, you are not alone. I know that's small comfort, but that's what's happening in the marketplace. So with an aging membership, loan to share ratios will also decline. And of course, that puts a lot of pressure on earnings capability. It leads to fewer member business loans as consumers reaching retirement age will have fewer business activities and fewer needs for business loans. And if you have a limited field of membership, such as a municipal-based credit union, the effects of your aging membership is compounded dramatically by the trend of a lack of hiring of new younger workers by the organization within the field of membership. And a lot of our municipal credit unions and and credit unions that have a limited field of membership, what used to be called an organizational credit union, they are seeing that as hiring declines for those newer, younger employees. Now, if left unchecked, this trend of an aging membership can ultimately threaten the purpose and existence of the institution, leading to an increasing number of mergers, thereby further consolidating our industry. And further consolidating our industry is not good for any of us. And it really is bad for the credit union movement because we don't want to lose our smaller institutions. They are the fabric, really, of our movement and the original purpose of why there are credit unions, over 100 years ago. Now, when we look at data, so what's going on with our membership? So if we look at the data as of September 30th, which was just released last week by the NCUA, the rate of membership increase in MSIC member credit unions is way below the averages for both all credit unions in Massachusetts and all credit unions in the nation. So let's look at the data since December 31 of last year. The membership growth in MSIC's 73 members is up 1.3%. For all Massachusetts credit unions, it's 2.86%, but for all credit unions nationally, it's 4.03%. Now that is a striking differential, and we've spent some time over the last year trying to figure out why that is the case. So in addition, some of our peer groups, for example, those institutions that are less than 100 million in assets, have actually reported a decline in membership levels over the past 5 years. That is a very troubling sign. So 2 questions that we're going to try and address today to the best that we can. Why is the MSIC cooperative lagging in membership growth, and what should be done about that? So let's deal with the first question. There's absolutely no good reason why MSIC member credit unions are lagging in the rate of membership growth. In addition to all of the other benefits which credit unions have offered consumers over the last 100 years, our full deposit insurance gives MSIC member credit unions, all of you, a massive competitive advantage over non-member credit unions and most banks. And you're seeing that with the surge in excess deposits that we've experienced over the last 5 years. Member business lending, member business organizational members, consumers have been flocking, and excess shares and deposits, which we insure, are now around 9% of total deposits at our members, which is way above the national average. And also the Filene Research Institute, in some of their studies over the last decade, have shown that 80% of a credit union's profits come from the top 20% of depositors. So it's a very lucrative slice of your book of business, and it has been growing substantially. Last year alone, our excess insurance grew by 25%, on top of 28% the year before. Now, with that benefit, we should be seeing more members, but we're not. As you saw from the data that I just gave you, we're lagging way behind the national average. Now, when you look at all Massachusetts credit unions, which is MSIC members are part of that group, why is that higher? That higher is because of DCU. DCU is so large and has such a scope of business. They're way above, I think they're in the $10 billion range now in total assets, and they're way above their nearest competitor in Massachusetts. So they skew those numbers on the membership growth. If you take away DCU from that analysis, the membership growth of the remaining Massachusetts non-member credit unions is about the same as our member credit union growth, around 1.3 to 1.5% since last December. Now, but even with DCU, we're way below, Massachusetts is way below the 4.06% that the nationwide credit union group, all 5,000 institutions, are showing over 4% growth. So we have to ask ourselves, why is that happening? So our conclusion has three main elements. First, nationally, credit unions have a higher level of consumer loans. Now, this requires a more active membership engagement, as the credit unions need a higher turnover rate to sustain a consumer loan portfolio. For example, first mortgages generally have an average life of 7 years. It may be longer now because of the low interest rates over the last few years, but consumer loans have a much shorter turnover duration. So nationwide, credit unions are more actively engaged with consumer lending, which requires a much broader effort at bringing in new consumers, new members, so that they can maintain the status of their consumer loan portfolio. The second element is that Massachusetts-based credit unions, and MSIC members in particular, have a long history of financial success and stability. And I think this has led, it's pretty clear to us that this has led to a complacency regarding the need to seek newer markets and younger members. And we'll talk about that a little bit more as we go on this journey together. And third, the hard truth is that loan operations in credit unions in Massachusetts are usually extremely inefficient, and they're not adequately connected to both marketing efforts and customer service or customer engagement efforts within the institution. Too often, the loan operation, because it's a specialty, is set aside, and there's no connection between the other aspects of the operation in order to grow a membership base. Remember, we're not banks, we're a membership organization, and that requires a whole different set of attitudes and skills in order to grow that membership base. But when you look at your loan operations, you're going to see a high degree of inefficiency. Now, I could add that we're also terrible at telling the credit union story. All of the research from the Fed on the issues, culture and issues surveys of the younger generations show that they are more like their grandparents' generation in terms of values, and they really like the credit union model, and they like that we're a cooperative, and they like that we do all kinds of charitable work and we're involved in our community, but they don't know the first thing about us. Many of them still believe that you have to be a member of a labor union in order to join a credit union. And all of the filing research, surveys that they've undertaken, including, interviewing people on the street, all of those, show that younger consumers have no idea who we are. But that is not an issue for Massachusetts alone, because it's really a factor for all credit unions, not just Massachusetts or MSIC members. So that can't be the reason why we're lagging in the membership growth. And the other factor it could it be because Massachusetts is overbanked? We, are historically known for having more banks, more branches in Massachusetts, banks, credit unions, all financial institutions. Per capita, we're one of the highest in the nation. But that can't be it. Is there more competition for business? I think that's an excuse, because the rest of the nation is also mostly overbanked, except in low-income areas. America has more banks per capita than any place in the world, and we are competing constantly for consumer share of wallet and also for new consumers. And frankly, low-income areas are underbanked, even in Massachusetts, and we're weighted in terms of low-income areas. 58% of our member institutions are low-income designated credit unions. So those are not overbanked areas. So I don't believe the competition, the level of competition, is the reason why we're lagging the rest of the nation. I don't think that holds water when you really look at it. Now, we're going to have, as Erica mentioned, some other webinars starting in February and March through this into the summer. And we'll talk about the merger fallacy and telling our credit union story in those webinars. That they go way beyond what we're trying to do here today. So now that we know this is a problem and we think we have a conclusion as to why, what should we do? Um, Before I start going into this, I want to say first, we have to recognize that this is a very serious problem. And it's not a short-term problem. It's not just something we discovered this year. This has been going on for some time. As a matter of fact, when I say we have 1.7 million consumer and organizational members in our cooperative, that's the same number we had pre-pandemic. That's the same number we had 5 years ago. It has not increased hardly at all in the last 5 or more years. So this is really a long-term problem. So first, we need to address the issue promptly, and we have to educate your management teams and your directors as to what needs to be done to address this issue, what needs to be done to grow your franchise. Resources have to be committed to this effort. And we believe that we have to break the mold of our operational culture. You need to run our operations differently, more effectively, and we need to do it quickly. So what do I mean by that? In short, we really need to learn to compete. We have benefited from a 20-year declining interest rate environment. It's a generation of leadership at credit unions and banks in which we could just thrive by serving our existing members. It's the walk-in culture. So members want to refinance their loans and they walk into our branch and we refinance their loans. Or we get a new customer here and there, or they refer their brother-in-law or their cousin and we get a loan here or there. But we're not actually competing for market share with our main competitors. And our main competitors are not each other. Our main competitors are the larger banks that have moved into Massachusetts, Chase, JP Morgan, mortgage companies who are scooping business away from our local communities. We can compete with them, but we have forgotten how. Now, this requires a cultural change. And it's a cultural change that we see in most, if not all, of our member institutions. And don't let me, look like I'm saying cultural change is easy. Cultural change is extremely difficult. But I want to give you an actual example, and it's completely true. And I'm going to leave the names out to protect the guilty here. So there's a young couple who was looking for their first home mortgage, and I encouraged them to go to one of our large credit union members, and they did. He is a young lawyer, fresh out of law school. She is a young physician, 2 years out of medical school. They'd saved enough for their down payment, and they wanted to buy their starter home. And so they went and applied at one of the MSIC's larger credit union members. Now, the loan officer and they had some communications. The loan officer sent some list of documents they needed to provide to start the underwriting process. They provided them. The loan officer came back and asked for a second set of documents. They provided them. And then the loan officer came back with a third set of requests that included some of the documents that had already been submitted. So they submitted them again. And then the loan officer came back about a month later and asked for another set of documents, some of which had already been submitted once or twice before. So they called up the loan officer and said, look, we're happy to keep doing this, but we've already submitted 5 of the 7 documents you've requested. And the loan officer said something to the effect of, well, we have this new loan system and I don't like using it and it's all online and I sent it all to our underwriter and I can't find them and the underwriter says she doesn't have them. And so I don't know what to do here. I don't really understand the system. I prefer the old paper way that we used to do it. So why don't you take the whole list and just copy them on paper and send them to me? and we'll start fresh. This is a true story, folks. And so they did. They asked the loan officer to send them a list of all the documents she needed. They copied them on paper. They marched down to the post office. They sent them by registered mail or certified mail. They might have FedExed them. I don't remember all the details, but they sent them a final time. The loan officer confirmed that they'd gotten it, and they didn't hear anything else. So a month goes by, 2 months goes by. So they call up the credit union to try to reach their loan officer. Their loan officer had left the credit union. It had been assigned to a new loan officer, but that new loan officer hadn't bothered to reach out to them and tell them. They asked about the commitment letter because now they were facing some timing problems on their closing for their starter home, and they were getting worried. And so the new loan officer said that they would check and get back to them. A week goes by, 2 weeks go by. They call again. Yes, the commitment letter had been issued. It had been issued 6 weeks earlier, but no one had sent it to them. So they sent them the commitment letter, and we moved now to the closing. Long story short, you get the picture. When this settlement statement was sent, the settlement statement had the wrong address, the wrong loan amount, and had spelled their last name incorrectly. I'm not making this up. So they got the settlement statement corrected. They finished all of the underwriting process. They went to the closing, and lo and behold, the closing attorney had the wrong first settlement statement, and the closing had to be delayed while it all got sorted out while they and the seller sat there. Okay, we closed the loan, they bought the house, they went on. A couple years later, they can refinance because of the declining rate environment. What do you think happened? There was no way they were going back to that credit union. As a matter of fact, they wouldn't go to any credit union, and they went to a local bank and got their refinancing. 3 years after that, they bought their permanent home, a much larger home. They're successful young professionals, and they wouldn't even consider any credit union. They got their mortgage for their permanent home with a bank. So, and I referred them. So it's not only embarrassing for our movement, but this is exactly the kind of young consumer that we need to get and retain, because getting them is a hard thing to do. Keeping them is actually harder. We need to perform to do that. So if we dissect what went wrong here, I mean, where do I begin? We had a walk-in operational culture. It was not consumer friendly. The loan officer wasn't trained. There was incompetence in the loan system and the closing process. There was a lack of consumer needs focus. This wasn't even close to being user-friendly, and there was no coordination within the credit union to try to get this done and to retain these new young members. There was no outreach, and every area of the credit union, from HR to lending to customer service, failed to connect with exactly the kind of young consumer we talk about getting. This was a disaster. And there was no effort to retain them, no effort to make them feel like members. Once they got that loan, they never heard from the credit union again. There wasn't even a request for deposits. There wasn't a request for, how's everything going? Are there other things we can do for you? There was no contact at all. This is a credit union bureaucratic focus and not a customer experience focus. And we see this far more often than all of you and your CEOs want to admit. Now, it's not unique. Many of our credit unions have demonstrated some of these problems, but I think this was an extreme case in that I didn't see anything in this process that was right. Now, our credit unions aren't that bad on average, but this was a large, successful credit union that should have been able to do this transaction with their eyes closed. This was exactly the kind of new consumer that we want. It's that bureaucratic walk-in culture, and we don't admit it, and we don't admit it to ourselves, but far too often our loan processes are, quote, we service members who contact us, and we do it on our terms where we are ready. We talk about customer service. We talk about how credit unions are more customer friendly than banks. We talk about it and we talk about it, and we have consultants and we have people on the national level talking about it. But what actually happens on the ground? Now, this works. This walk-in bureaucratic culture works in a 20-year declining interest rate environment, which we're relying mostly on loan refinancings for our pipeline to drive our business. But it does not work now because that business has dried up. So if we're going to address this problem honestly and concretely, we have to convert our operations to a sales and a high performance culture. And that is doable, but it's not easy. We have to put the new young members first. We have to meet their needs, not just our needs. So what do they want? This isn't rocket science. They want loans at a good price with minimal difficulty. They want to get the deal done quickly without being hassled. And we have a whole fintech business out there that is focusing on minimal difficulty. And the reason fintech is working on minimal difficulty, and remember, price isn't always the lowest at the fintechs, because the Fed research on those consumer values show that young borrowers are more interested in getting it done quickly and easily than they are price. And they will spend a little bit more if they can do it in a way that's efficient without being constantly hassled in the process. And fintech is delivering that. We're really not. So what do you need to do? First, review your loan products and make sure that they are in line with what the market is likely to need. Right now, it's mortgages, home equity lines, and home equity loans, as well as the standard consumer lending. Second step is review your loan operations, and you need to do that with a clear eye. It needs to involve the CEO and the CFO and the chief lending officers, and they need to really take a hard look at how we're actually performing. And if you can't figure that out from within the organization, because sometimes it's really hard, do some surveys of your customers, of your members. Do some surveys of your new borrowers. Ask them how it went. Find out what they think, and that will give you some guidance as to whether or not you are efficient or not. And then the third step, in almost every case, you've got to modernize your loan processes. The market is moving well beyond our traditional ways of doing business. Fintech is the prime example. There are new patterns. There are new online processes. There are new, quick, efficient ways to get your mortgage lending, and consumers are flocking to that. They are not going to flock to organizations that have an inefficient loan process. You have to save money and staff by outsourcing everything that you can. You have to use the dollars and the staff saved in that outsourcing process to improve sales. Your loan staff should be originators. Now, I don't mean that in the way we talk about loan originators. I mean they need to be out in your field of membership, bringing in new loans and new members. They should not be paper processors, especially now that loan pipelines have dried up because of the interest rate spikes. Almost all of our members are carrying a huge infrastructure that doesn't have enough to do. And that inefficiency is cutting on your profits, and it's cutting on your effectiveness in bringing in new members. Most of your lending staff should not be working in the back office. There are better, more efficient ways of doing that. You should be out bringing in new members. And, we call them members, but they start as customers. We're no different than the banks. We need to bring in new customers. It's after we get them in the door that we turn them into members. That's where your customer service platform and all of the other platforms that you have need to reach out and make them part of the family. That's how a customer becomes a member. They don't walk in as a member. You have to bring them into the fold, and that requires a coordinated effort. So, outsource your back office loan processes to improve performance, save money, and most importantly, free up your staff to get into sales. It will also improve your compliance burden relating to loan operations if you outsource to a world-class operation that handles the compliance aspects of your mortgage lending. It'll spread your costs over a larger base through collaboration with other institutions. Those of you who've been listening to us for the last 5 or 6 years know that collaboration, we believe, is the key to a long-term future for our movement. And it'll save you from an inefficient infrastructure during lean times and reduce your overall costs. A world-class provider who does this primarily as their focus with well-experienced people will free up your customer service staff and will improve your customer experience in the loan process. And that tees them up to become members because they'll have a happy, efficient, prosperous service. So you have to make sure that your whole organization is focused on this new member. They have to coordinate to provide that exceptional customer experience that goes beyond the loan closing. That's the only way you'll get more of their wallet share, and it's the only way that you will keep them and their family members and their friends as future members of your credit union. This is hard. It requires focus, it requires performance, and it requires a culture change, and it has to start with the CEO. All aspects of the organization have to be in alignment on this new change in how we're going to do business. But I think it's clear, the data is clear, that most progressive credit unions will be the ones to enjoy long-term success and will be the survivors in our movement. And the final thought is, there's a lot of consumers out there. Massachusetts is a lot bigger state than 1.7 million members. There's a lot of them out there, but you have to go get them. There's no other way. They won't walk in the door. So next year, MSIC is going to be offering services to help you in this necessary transition. Contact us. We can help you in the process of modernizing your operations, not just loans, but also other aspects of it. We're fostering collaboration among our members on a whole host of things. We're going to move into marketing and other, types of operations so that we as a collaborative can share the costs of reaching these newer, younger customers. I think we can do this much more efficiently and cheaply if we work on it together. But time is of the essence. We cannot lag in our new membership growth in the way that we are without having some long-term and serious issues facing our member institutions. Okay,